Well, welcome to chapter 15. Let's talk about exempt entities. So I'm looking at the book, and as always, just make sure you take a look at the big picture. It's right there. And so page 1 of your chapter is what talks about that and gives you the information that's right here. So Hopeful is a nonprofit, a 501c3. You probably have heard that term before, a 501c3. So Section 501 is kind of that nonprofit section of the IRS code. And then typically a 501c3 is some kind of a nonprofit organization that's providing services or some benefit to the greater good. And so Hopeful is a 501c3. Annual operating budget is $12 million. 2 decades ago, Betty Jones was a recipient of their services. And Betty owned a ice cream shop, Taste Good Ice Cream, a chain of 40 gourmet ice cream shops. And she is leaving basically the ownership of the ice cream shops to Hopeful. The business has been in existence for 8 years and produced substantially higher profits each year. Now the board's trying to figure out what to do with this in consideration of the following options regarding the bequest from Betty. And they hired us, their tax accountants, to help them figure out what to do. And so one option, sell the stock, basically is sell the chain, and then those proceeds would go to the endowment and benefit Hopeful that way. Continue to conduct the ice cream shop as a division of the current nonprofit, or maintain it as a wholly owned subsidiary of Hopeful. So one of those three options would be what we could go with. With the second and third options, existing management team will remain in place of the ice cream shop, and they'll just continue to run it. And then after-tax profits not needed to expand the ice cream shop chain will become back to Hopeful and carrying out its exempt mission. So, they'd keep whatever profits they need for expansion, remodeling, or anything like that. But above and beyond that, Hopeful would get the cash. Okay, so the question then is, what should we do? With each of the choices, what are the consequences or things to think through with any of those? So the first part of the chapter kind of just goes through and explains what a nonprofit is, or what they call exempt status organizations. I guess for whatever reason, I typically just use the term nonprofit, but I shouldn't be saying that. They really talk about exempt organizations. So they typically serve the general good. Groups serve maybe broadly defined or narrowly defined, but either way, it's a nonprofit entity. Some requirements then. Net earnings of the entity do not benefit members of the organization. Obviously a corporation's earnings would benefit the members through dividends and things like that. Prohibition differs for various types of exempt entities. The code basically says it may preclude benefit of any private shareholder individual, or may say earnings must be devoted to specific causes. The entity in general is generally prohibited from attempting to influence legislation or participating in political campaigns. This applies to both to positive and negative for or against a particular candidate. Examples then, there's many examples, and I'm sure everybody's aware of what those are. Federal and related agencies, religious, charitable, educational, scientific, literary organizations, civic leagues, employee unions, labor, agriculture, and horticultural organizations, business leagues, chambers of commerce, real estate boards, social fraternal clubs and societies, retirement funds, associates, cemetery companies, basically funeral homes, credit unions, mutual insurance companies, corporations that are farmers co-ops, armed service member posts and organizations, and group legal service plans are all examples. Religious and apostolic organizations, cooperative hospital service organizations, educational institutions, qualified state tuition programs. And USF being a private faith-based school, we fall under that nonprofit umbrella. So consequences, you're exempt from federal income tax, so you still file a return, but you're exempt from paying the tax. Exempt from most state income, franchise, sales, and property taxes also, so you don't really pay much in tax at all. So USF, for example, does not pay any property tax. There is no state income tax in South Dakota, and generally we don't pay sales tax. qualify for reduction in postage rates, and gifts to our organization can be deducted by the donors. And that's kind of the key for us, is we rely on a lot of our donors and alumni, and then whatever gifts they give us can obviously be deducted from our tax returns. Of course, there's always exceptions, and that's what we'll probably be focusing on the most, because understanding what they are isn't that hard. It's the exceptions that require a little bit more investigation. What if you engage in a prohibited transaction? You're a feeder organization, a private foundation, or you generate unrelated business taxable income. And so now think of our ice cream shop and how that fits into Hopeful. And you might see a couple of things here that go, it might be a feeder, or it might generate unrelated business taxable income. So prohibited transactions, if you are continuously engaging in prohibited transactions, part or all of your income will now all of a sudden be subject to federal income tax. You'll be forfeiting your exempt status, and there may be some sanctions imposed on insiders. So essentially, senior management may pay some penalties on top of that. Exempt organizations and influencing legislation. You can see here what some of the rules are. So you are allowed to do some. So the earlier slide mentioned you're not allowed to do some lobbying. Well, there's some minor exceptions to that within the limits. So you are allowed to do a little bit because USF, as an example, as a nonprofit educational institution, well, occasionally there's federal laws or state laws that might come up that you want to visit with your legislators, visit with congresspeople, hire a lobbying firm to help advocate your position, and so on. With the tax law that came into play a year ago, there is a provision that there is an extra tax now on universities that don't spend all of their endowment, for example. So that did not apply to USF. Our endowment is decent, but it's not anywhere close to what the limits are that they're mentioning in the law. And in fact, the book only mentions there's only about it's a very small number, like I want to say 30 schools. I forget the exact number, but not many schools at all actually will be subject to it. But nonetheless, they were talking about that threshold being much lower than originally was. So, if you were a school affected by that, you may have, hired a lobbyist to voice your opinion. So there is some lobbying you can do, but it's, there's a limit to what you can do. So as long as you're within your limits, all is good. You can maintain your exempt status. And that's really what this section is about. This is a good chunk of your homework too, will be about this. So just kind of make sure you've got a good handle on that. And they kind of begin to mention this then, it's on page 5. And before I mention page 5, I should mention page 4, which is Exhibit 15.1, which lists all the various types of exempt organizations. It's a really long list. It's basically the section 501 and the various subchapters of 501 and the different types of exempt organizations that are out there. Okay, so then go to page 5, and that's where they begin to talk about some of the, so generally you're exempt unless you do certain things, and then you've got certain limits and so on. And that's really what page 5 is about. You are allowed to do some lobbying within reason. Okay, so generally you lose your exempt status if they attempt to influence legislation or participate in campaigns, except that you can, within a small degree, you can do some lobbying. Okay, if elected, you don't have to by any means, but I can think of when the tax law was being discussed a year ago, there were many provisions that were going to affect private universities, and USF belongs to a large group of universities who then basically lobby on the group's behalf. So it should still happen. I mean, it makes sense that there should be something allowed, because if a Congress or a state legislature is going to pass some legislation that would affect you, you need to have your voice heard and be able to, advocate for your position. So that's kind of where they're at. So there's a ceiling about how much you're allowed to spend. If you exceed the ceiling, potentially you could lose your exempt status. Now, if it happens for a year, I think you'll pay a penalty, but you can probably keep your exempt status. But if it happens continuously enough, you will definitely lose your exempt status. So you have a ceiling that you can reach, and you may have to pay a tax on some portion of your lobbying expense. Okay, so it's kind of FYI. So lobbying expenditures are made for the purpose of influencing legislation by attempting to affect opinions of the general public or any segment thereof, communicating with the legislature or a staff member or any government official or a staff member who may participate in the formulation of the legislation. So all that comes into play. Also, the statutory ceiling. So this is where you'll need to know this for your homework. And this, they kind of give us the example. I think probably the best, they kind of mention this in the bottom of page 5 is where it's at. And they kind of begin to walk you through some examples then on 6 and 7. So the statutory ceiling on lobbying expenditures is the ceiling is 150% times the lobbying non-tax amount. And the lobbying non-tax amount is the lesser of $1 million or an amount determined based on exempt purpose expenditures. And the tax then is 25% times excess over your lobbying non-tax amount. Okay, so whatever you incur above your non-tax amount, you pay a tax of 25% on. And then a grassroots expenditure is expenses to influence legislation by attempting to affect the opinions of the general public or a segment of the public. Like TV ads, radio ads, marketing, anything like that, where you're advocating for a particular position. The ceiling is 150% times any grassroots non-taxable amount. The grassroots non-taxable amount is 25% of the lobbying non-tax amount, so 25% of this amount here. And the tax is 25% on the excess over your non-tax amount. So both of them have a 25% tax. And this is basically the brackets, the tax brackets. So just like you'd have a tax bracket for individual taxpayers, it's kind of the same thing then for exempt organizations. And the same bracket that you see here is on the very top of page 6, Exhibit 15.2. So just kind of make sure you know what that is. So when you do the homework, and when we go through a couple homework problems together, we'll refer back to this. They're going to give us the amount of expenses, and then basically that determines our bracket over here. Okay, so this is determining what the non-tax amount is. So this helps us figure out the non-tax amount. And I know that's really hard to see. Let me make that bigger. It's really fuzzy. I don't know why that's so darn fuzzy, but it is fuzzy. And you can see here, and then we make an election. So basically, the lobbying non-taxable amount then becomes, it says without an election, 501H, a 5% tax is assessed. With the election, exempt status is not jeopardized unless lobbying or grassroots expense ceiling is repeatedly exceeded. So below that amount, no tax. Between lobbying, grassroots expenditure, and the ceiling is 25% tax. Expenditures above that 5% on all lobbying expenditures, exempt status is jeopardized. So you got to be really careful what you spend on these things. So here's an example. TAN Inc. is a qualifying 501c3, incurs a lobbying expense of $525,000 for the year. Exempt purpose expenses for the year are $5 million. TAN elects to be eligible to make lobbying expenditures on a limited basis, so they make the election. What tax liability results in this from this lobbying activity? Okay, so we go here, and we are at the remember that they're at the 5 million mark right here. So at 5 million mark, I want to show you goes to here. And we look at this bracket here, and expenditures over 1.5 million. We're at 5 million for our example. So we're at 225 plus 5% of the excess of exempt purpose expenditures over 1.5 million. So 225 plus 5% over 1.5 million. That's where we're going to land. So with that in mind, here we go. So here's our example again. We incur 525. Our expenditures for the year are 5 million. and then we go from there. So the lobbying non-tax amount is $400,000. It's $225 plus 5% of the difference between $5 million and the $1.5 million. Okay, so the $5 million are actual. We're in the $1.5 million bracket. So $225 plus 5% of that difference. The ceiling is $600,000, which is $400,000 times 150, 150%. So the 525 is under the ceiling. That's good. So we're good there. The tax is imposed on the excess of lobbying expenditures of 125. So basically, we're taxed above 125. So we spent 525, and our non-tax amount is 400. So we spent 125. So we got to pay a 25% tax on the 125. So we could have spent up to 400,000 and not paid a penny in tax. But we spent more than that, so now we have to pay a tax. Good news is we're still under the cap, what we were capped at. Okay, so now it says here, take the intermediate sanctions, and these are on page 7. These can be pretty strict here. This is kind of a big deal to me. I don't work, I obviously I work at a nonprofit, but I'm not in management at a nonprofit. But if you are, you better take note of some of these things here. So take the form of excise taxes imposed on disqualified persons and on exempt organization managers. So a disqualified person is an individual who's in a position to exercise influence over the affairs of the organization who engages in excess benefit transactions. Okay, so they're getting some extra benefit by working at this nonprofit over, above, and beyond what we would kind of be considered to be reasonable. So they get some kind of a non-fair market value transaction and or receive some kind of unreasonable compensation. So their compensation is really high for their position and what the charity does or the amount of revenue the charity has, whatever it would be. Okay, so there's two kinds of sanctions. First level is imposed on the disqualified person. So the person who is getting this unreasonable benefit, they have to pay a 25% on the excess benefit. So whatever amount is above and beyond excess, they pay 25% on. And then there's a ceiling of $20,000 for any excess benefit transaction. And then there is so the exempt organization manager imposed at a 10% rate. So the disqualified person pays 25%. A manager pays 10%, capped at $20,000. Then the second level tax is imposed on the disqualified person if the excess benefit transaction is not corrected within the taxable period. So if the person, the disqualified person, pays a tax of 25%, and if they don't fix it, like give the money back, okay, they pay a 200% tax on the excess benefit. So that's where you're like, you don't want that, right? You don't want to pay a 200% tax on that. They give two really good examples on page 7. There's examples 2 and 3 there. Just take a look at those and you go, yeah, I don't want to pay that tax. That's what you'll agree on. Okay, so a feeder organization then. This is going to bring us back to our ice cream shop and Hopeful, our charity that's going to inherit the ice cream shop. So a feeder organization carries on a trade or business for the benefit of an exempt organization and remits profits back to the exempt organization. It's not exempt from tax, so the ice cream shop will not escape taxation by being associated with a nonprofit. Okay, so that it prevents the exemption from tax simply because profits are payable to an exempt organization. Okay, so they will still pay a tax, so they're going to be taxable just like they currently are. So going back to our big picture example, it assumes that Hopeful has decided to operate Taste Good as a subsidiary. So it's just going to essentially say it'll be absorbed into Hopeful. The ice cream shop will be. It'll be a wholly owned subsidiary of the ice cream shop. Let me say that right. And it will not be tax exempt. Hopeful is, but the ice cream shop is not. So it's going to pay tax, just like it normally did. Okay. And if it's a corporation, it's subject to all the federal corporate taxes, just like it always has been. So nothing changes there. And then it says private foundations. So it mentions a few things about private foundations here, kind of more FYI in my opinion. They're at the very bottom of page 8 is where you'll find this. It's classified as such because it serves a narrowly defined common good. It's not being viewed as being supported by or operating the good of the public, and it may produce some negative consequences. It may have an adverse impact on the contributions received by the donee exempt organization. It may result in taxation at the exempt organizational level. So the following organizations are not private foundations. So churches, educational institutions, hospitals, medical resource organizations, charitable organizations receiving support from the general public or the U.S., a state of or a political subdivision operating for the benefit of a college, university, and governmental units. So because they're broadly supported, they would not be a private foundation. However, a lot of people do set up private foundations. You'll hear that famous athletes do that. Some businesses will do that. And so basically the foundation supports some narrow cause, like an athlete might say they strongly believe in supporting veterans. So they'll create a private foundation, and then all the proceeds from that foundation will benefit veterans causes. So if it's housing, medical services, rehabilitation, whatever it would be, it was very narrowly defined. They're not necessarily seeking public money for that foundation. Maybe the athlete is the one funding the foundation, maybe with some fundraisers and things like that. But it's not the same as a United Way campaign or a Red Cross campaign, where essentially they're reaching out to the entire public to say, please give us to help us support some very big, wide-ranging causes. So it's a little bit different. Okay. So it says to meet the broadly supported test, both the following must be satisfied. External support, more than a third of support must come from 3 groups above in the previous slide in general forms: gifts, grants, contributions, membership fees, gross income from admissions, sales of merchandise, performing the services, or the furnishing of facilities and activities not unrelated to the trade or business. Okay, so just a few small rules to think through. To meet that in number 2, both the following tests must be satisfied. So the internal support test lists the amount of support normally received from the following sources to 1/3 gross investment income and unrelated business income minus tax. And then so some foundations may deal with taxes that most non-exempt organizations don't deal with. So kind of more some kind of almost like a sales tax to some degree. So there's a 2% fee on investment income to defray IRS expenses and so on. So just a few there. So if you're a private foundation, just know that you may be subject to some taxes that a non-exempt entity would typically not be. Okay, so it's just more of a be aware of than anything else. Okay, so I'm just going to kind of go through that. Then I'm skipping the UBTI, unrelated business income tax. Well, you know what? I apologize. I forgot something else I was going to skip. This is not it. My bad. So this comes back to the big picture, right? So, the ice cream shop, obviously, right? It was a separate corporation, 40 stores, very profitable, making money, paying tax. It's now going to be owned, though, potentially owned by, unless the charity sells it, by an exempt charity. Okay, so they still have to pay tax. That's kind of essentially what it's about. Now, obviously, there's always some exceptions to that, and it says here state college and universities are one of those. Okay, so it's still carrying on a trade or a business, so therefore it's subject to tax. Okay, so now they're going to operate as a division. So if it's a division, it's absorbed into Hopeful. And as a division, it's now considered to have UBIT, unrelated business income tax. And trade or business is broadly defined, includes any activity for the production of income through the sale of merchandise, the performance of services. To be related to the exempt purpose, the activity must causally related and contribute importantly to the exempt purpose. Of course, there's always exemptions. Substantially all work is performed by volunteers. Substantially all merchandise being sold is received as gifts or contributions. For 501c3 and or for state colleges and universities, the business is conducted primarily for the benefit of members, students, patients, officers, employees. For most employee unions, the trade or business consists of selling to members work-related clothing and equipment and items normally sold through vending machines, snack bars, or food dispensing facilities. There's a $1,000 provision, so if the gross income from an unrelated trade or business is less than $1,000, then don't worry about it. So that's a pretty small threshold, though. That to me that's really tiny. Then I'm going to skip from there. So that covered kind of the big stuff, and that's what you'll get. So I was confusing that with this one. So anyway, so that will get you down to the let's see, a couple there. So let me come back to this one, unrelated business taxable income. So it's really simple. This is really easy to compute. Is you take your unrelated business income minus any deductions related to getting that income, plus with some adjustments, and your $1,000 standard deduction, and then that is your UBTI. And some adjustments would be charitable contributions in excess of 10% of UBTI, unrelated debt financing income, and then negative adjustments with dividends, interest, annuities, royalty income, and so on. Okay. And also some rent income from real property and from certain personal property. And then gains and losses from sale, exchange, or disposition of property except for inventory. And there's a $1,000 standard deduction that is allowed. And then unrelated debt financing income is a positive adjustment. Debt financed income is gross income from debt financed property. Debt financed property is all property held to produce income on which there is acquisition indebtedness, except for a few little exceptions right there. And then certain land is excluded from debt financed property. And then your annual filings, you have to file a Form 990 basically on May 15th. So you've got a while to do that. So May 15th, file a Form 990. And then it says Form 990T, if at least 1,000 gross income is from unrelated trade or business, and a Form 4720 if an exempt organization is subject to any excise taxes imposed on private foundations. And so coming back to our ice cream shop, it's exempt from federal income tax only on the conduct of its charitable activities. But however, of course, it inherited the ice cream shop, and that we all know will be taxed. If they sell the stock of the ice cream shop, it says unlikely to result in a gain. The fair market value has probably not changed very much in the time between Betty's death and then when they begin to sell it, so most likely not a gain. If in any case, it's not relevant because any realized gain on the sale of stock is tax exempt because they're a 501c3. If they operate as a division, the taxable income is classified as unrelated business income. Is competing with for-profit entities, it's subject to federal income tax that applies to corporations. If it's a wholly owned sub, under the option, the ice cream chain is classified as a feeder organization, and so basically the tax consequences are the same. Either way, you're going to pay tax. So if you keep it either as a sub or absorb it in as a division, the tax consequences are exactly the same. If you sell it, basically you're exempt from any capital gain tax. You just take the cash and you use it for the endowment or to benefit the charity. Okay. And of course, what they'd have to be careful about though is you don't want to change the tax status of Hopeful itself. If it owns too much of Taste Good, they could lose their tax status and become a private foundation, which of course means they'll have to pay some extra tax. So be careful about that. Okay, and that's it. So I think it's a pretty straightforward chapter. Obviously, if you've got questions, just let me know.